Hey everyone, welcome back. If you have been looking at this market and thinking, wow, everything already feels expensive, you are not crazy. The S&P 500 is near record highs. The Nasdaq is near record highs. The Dow already touched 50,000 earlier this year. So yes, the easy trade feels crowded right now. And that is exactly why this conversation matters. Because when the big indexes are stretched, the next serious opportunity usually is not sitting in the most obvious mega cap that everybody already owns. It is usually hiding somewhere earlier, somewhere less crowded, somewhere the story is still forming. So here is the question today. If the broad market is already elevated, where can a retail investor still find real upside in commercial space? And let me frame this the right way from the start. This is not about chasing the next lottery ticket. This is not about blind hype. This is about finding companies where the business is still scaling, the story is still early, and one or two real wins could completely change how Wall Street prices them. We are not looking for noise. We are looking for inflection. Now let's say the obvious thing out loud. Commercial space is hard, really hard. It burns cash. It depends on milestones. It depends on engineering. It depends on timing. And the stocks can look absolutely insane. One month they feel unstoppable. The next month they look broken. But here is the flip side. That is exactly why retail investors still have a shot here. The biggest winner in space is still SpaceX, and most people cannot buy it. So the public market version of this theme is different. You are not buying the winner after everyone already knows. You are trying to identify the listed companies that can win pieces of the build-out, launch, satellites, direct-to-phone connectivity, lunar logistics, defense-linked space systems, all of it. That is the opportunity. The space economy is still being built in public. And if you stay disciplined, that gives you a lane. And I really think this is one of the most interesting themes to watch right now in April 2026. Governments are spending more on sovereign space capability. Defense budgets are pulling space deeper into national security. AI is making orbital infrastructure more important, not less. And at the same time, the obvious AI trade has already been chased hard in big caps. So if you want asymmetry now, if you want a place where upside still feels less crowded, commercial space deserves attention. Especially the companies that are moving from story to revenue, or from niche player to actual platform. The three names I think are most worth watching right now are RocketLab, AST SpaceMobile, and Intuitive Machines. And I like this group because these are not the same bet. Not even close. RocketLab is the more proven operator. AST SpaceMobile is the huge upside, high volatility moonshot. Intuitive Machines is the lunar infrastructure and cislunar logistics play that still feels early to most people. And that matters. Because the worst way to invest in commercial space is to treat every stock like the same story. They are not. These are three different setups, three different risk levels, three different catalysts, three very different ways the thesis can work or fail. Let's start with RocketLab, because if there's one public space stock that is starting to feel less like a concept and more like a real operating company, this is probably it. Most people still hear RocketLab and think, small launch company, and that is already too small. That label misses the bigger picture. RocketLab is becoming a vertically integrated space systems business. Yes, it launches rockets, but it also builds satellites. It sells components. It is expanding into defense. It wants a much bigger role in constellation infrastructure and national security. So this is not just a story about sending small payloads into orbit anymore. This is a bigger systems story. And the reason the market keeps paying attention is simple. The numbers are no longer tiny. RocketLab reported record fourth quarter 2025 revenue of $180 million. Full year revenue hit $601.8 million, up 38% year over year. Backlog finished the year at $1.85 billion, up 73% year over year. The company flew 21 Electron and HASTE missions in 2025 with a 100% mission success rate for the year. It also landed its biggest contract ever, an $816 million Space Development Agency award to build 18 satellites. Then management guided first quarter 2026 revenue to $185 to $200 million. That is real momentum. Not hype, not fantasy, real momentum. And this is where RocketLab gets interesting. Because the story is no longer just launch cadence. The bigger unlock is that the company keeps moving up the value chain. It is selling more complete space systems. It is selling more components. It has built out optical and precision manufacturing capability. It has pushed deeper into defense work through programs like SHIELD. And if that strategy keeps working, the market may eventually stop valuing RocketLab like a niche rocket name and start valuing it more like a diversified space prime with infrastructure and defense exposure. That is a very different story, and potentially a very different multiple. Now, the next huge catalyst is Neutron. This is the medium-lift rocket. This is the project that could change the size of the opportunity. Management now targets first launch in the fourth quarter of 2026, after a Stage 1 tank test failure pushed the schedule. So yes, the delay matters. You have to respect that. But the project matters even more, because Electron made RocketLab credible. Neutron is what could make RocketLab bigger. It opens the door to larger constellation deployments, more serious national security missions, a much bigger part of the launch market if Neutron works. RocketLab stops looking like a strong small launch company and starts looking like a much broader contender. Now, let's slow down for the risk. Because with SpaceStocks, if you ignore risk, the market will remind you fast. RocketLab is not some hidden secret anymore. The stock was around $88 on April 20th. Market cap was roughly $49 to $51 billion. So investors are already pricing in a lot of future success. The company is still unprofitable on a GAAP basis. Neutron is still unproven. And if timelines slip again, or if backlog conversion disappoints, or if defense momentum cools, that multiple can compress fast. So, no. This is not early anymore. It is early relative to what the company could become, but it is not early relative to the excitement already in the stock. Still, if you are a retail investor and you want the cleanest public market exposure to the commercial space build-out without going all the way out on the risk curve, RocketLab is probably the most complete package right now. It has real operations, visible revenue, real backlog, launch credibility, defense relevance, and a very clear milestone list the market can track. If those milestones keep getting checked, this stock can keep evolving. Now let's move to AST SpaceMobile, because this one is completely different. RocketLab is the more structured, more operational name. AST is the imagination stock, the dream stock, the one that can look brilliant one day and terrifying the next. The simple version of the story is powerful. AST is trying to build a space-based cellular broadband network that works directly with ordinary smartphones. No dish, no special hardware, no extra box, just your normal phone, connecting to space when the ground network is weak or gone. If that works at scale, this is not just another satellite company. This becomes a new communications layer. And that is exactly why this stock gets so much attention, and why it scares so many people. Now look at the numbers. AST reported $70.9 million in full year 2025 revenue and $54.3 million in the fourth quarter. The company says it has over $1.2 billion in contracted revenue commitments from commercial partners. It received a $175 million commercial prepayment from STC Group tied to a 10-year regional agreement. It expects additional launches every 1 to 2 months on average, with a goal of reaching 45 to 60 satellites in orbit by the end of 2026. Bluebird 8 through 29 are already in production. And on top of that, AST said it had more than $3.9 billion in cash, restricted cash and liquidity on a pro forma basis after financing activity. That is why the market takes this story seriously. There is real money behind it, real partners behind it, real ambition behind it. And what makes AST feel like a real breakout candidate is that it sits right in the middle of two massive trends at once: direct-to-device connectivity and resilient communications for sovereign and defense use cases. This is not a niche product story. AST wants to become the bridge between mobile operators and orbital broadband. If that bridge becomes real, the upside is obvious. But this is also where I need to be brutally direct. This is the highest volatility name in the group, and the latest news shows you why. ASTS Bluebird 7 launched on April 19th on Blue Origin's New Glenn bot. It ended up in a lower-than-planned orbit and is expected to deorbit. The company said the cost should be recovered under insurance, and it still expects regular launches this year. Fine, but the bigger message matters more. This story is still execution-heavy, still technically fragile, still dependent on launches going right. And the gap between where they are and where they need to be is still big. The company had 6 satellites in orbit, and still needs to get to roughly 45 to 62 support service at real scale. That is a huge jump. And the stock tells you how emotional this setup is. AST was around $79 on April 20th, with a market cap near $17.6 billion, while still posting negative earnings. That means the market is already looking far into the future. So, let's be clear. You are not buying AST because today's valuation looks cheap. You are buying it only if you believe the network gets built, the service works, the telecom partnerships turn into actual usage, and the company can hit milestones faster than skeptics think. If that happens, this stock could look completely different. If execution breaks, the drawdowns could be brutal. So, how should a retail investor think about AST? To me, this is the upside sleeve, not the core position, not the stable compounder. This is the name where you admit upfront that the dream is huge. The path is messy, and the real question is not whether it will be volatile. Of course, it will be volatile. The real question is whether the next 6 to 12 months can materially de-risk the thesis. That is what matters. So, what do you watch? Launch cadence, successful deployment of additional Bluebird satellites, early service activation, commercial partner updates, and any sign that the network performance is actually good enough to support a durable business. If those boxes start getting checked, belief changes fast. And in a stock like AST, when belief changes, price can move very fast. Now, the third name is Intuitive Machines. And I think this one still catches a lot of people off guard because too many investors reduce it to moon landing headlines. That is the shallow version of the story. The better version is lunar logistics and deep space infrastructure. This is a company trying to build capability for where both commercial space and government space are going next. Cislunar services, lunar payload delivery, data relay, navigation, and eventually the operating layer around sustained activity beyond low Earth orbit. Yes, it sounds futuristic because it is. But the contract base is starting to make it feel a lot more real. On the numbers, this business is already more substantial than many investors realize. Intuitive Machines reported fourth quarter revenue of $44.8 million. Gross margin was positive at 19% in the quarter. Combined company backlog was about $943 million at the end of February 2026. Management guided full year 2026 revenue to $900 million to $1 billion and expects positive adjusted EBITDA for the year. That is not tiny. The company also completed an $800 million acquisition of Lantora Space Systems in the first quarter of 2026. It closed the Kinet's acquisition. It launched EcoStar 25 in the first quarter, and it secured a $175 million strategic investment to advance satellite communications. And in space data processing, that is a lot happening in a short period, and that matters. Then you had the latest NASA catalyst. In late March, NASA awarded Intuitive Machines a $180.4 million COLPS contract to deliver 7 science and technology payloads to the lunar South Pole region. That includes an Australian rover and technologies from Blue Origin's Honeybee Robotics. That matters for a very simple reason. Each new mission is not just revenue. It is credibility. It is repeat customer trust. It is proof that NASA is leaning more on commercial providers, and it pushes Intuitive Machines closer to being seen as real infrastructure in the Artemis era. Not just a one-mission headline stock. And the bigger industry hook here is powerful. Space is starting to split into layers. Launch is one layer. Communications is another. National security constellations are another. Then you have the layer that supports activity on and around the moon. That is the layer Intuitive Machines wants to own. It wants to help build the delivery, navigation, data, and operational architecture of the cislunar economy. That is why the company talks about near-space network services and even a solar system internet. Yes, that sounds ambitious, because it is ambitious. But unlike a lot of ambitious stories, this one already has real government contracts attached to it. Now again, risk matters. This is still a developing business. Execution risk is real. Capital demands are real. The stock was around $28.56 on April 20th, with a market cap of about $1.88 billion, and EPS was still negative. The company used $56 million of free cash flow in 2025, although that was an improvement from the year before. And the business is exposed to award timing, government budgets, mission execution, and the usual delays that make space programs messy. So no, this is not a clean, straight-line software story. This is a contract story, a milestone story, a timing story, which means sentiment can get uneven fast, even if the long-term thesis remains intact. Still, I think Intuitive Machines deserves a real place on the shortlist because the market may still be underestimating how quickly lunar infrastructure is becoming investable in public markets. Not easy, not low risk, but investable. And if the company can convert backlog into revenue, deliver more missions, and keep winning strategically important awards, then the market may start valuing it less like a speculative moon stock and more like an emerging deep space infrastructure contractor. And that kind of re-rating can be powerful, especially because so many people still dismiss the category too early. So now let's pull back and answer the bigger question. If you are a retail investor, how do you actually play this theme without blowing yourself up? I think the answer is simple. Stop asking which one is the next SpaceX. Start asking which role you want to own. If you want the more proven public operator with visible revenue, real backlog, and multiple business lines, RocketLab is the most complete package right now. If you want the massive upside direct-to-phone bet where one real technical or commercial breakthrough could change everything, AST is the obvious high-risk, high-reward name. If you want exposure to lunar and cislunar infrastructure, Intuitive Machines gives you that angle most directly. That is the framework. And if you are newer to the space theme, here is the practical way to do it. Do not go all in on one name. Build the watch list first. Respect the calendar. Track the milestones. For RocketLab, watch revenue conversion, launch cadence defense wins, and Neutron progress into the fourth quarter. For AST, watch successful launches, satellite deployment, early commercial activation, and whether partner monetization starts to show up in a more real way. For Intuitive Machines, watch backlog conversion, NASA and defense awards, and proof that 2026 guidance is not just an aspiration. In a sector like this, the calendar matters almost as much as the income statement. And I want to put a very clear risk boundary around all of this. Do not size these names like safe consumer staples. Do not confuse a great story with a safe position. Commercial space stocks can swing on launches, delays, contract timing, financing, politics, and one sentence in a press release. So, if you want to play here, play like an adult. Smaller sizing, staggered entries, no chasing vertical spikes. And know in advance what would make you add, what would make you wait, and what would make you walk away. The people who usually do well in sectors like this are not the people with the loudest opinions. They are the people who stay patient while the market swings between euphoria and doubt. So, if I had to summarize the list in the cleanest possible way, I would say it like this. RocketLab is the best all-around public infrastructure name in commercial space right now. AST SpaceMobile is the the one where success could completely change the category, but the path is still chaotic. Intuitive Machines is the underappreciated lunar infrastructure play that could get a lot more attention. If contract execution starts matching the ambition, 3 names, 3 different versions of the future, 3 different ways for retail investors to participate. While the big indexes sit near highs and the market keeps acting like all the easy money has already been made. So now I want your take. Out of these 3, which one has the best chance to change how Wall Street thinks about commercial space over the next 2 years? Is it RocketLab, the execution machine? Is it AST, the direct-to-phone swing with huge upside? Or is it Intuitive Machines, the lunar infrastructure angle that still feels early? Or maybe you think the real winner is another public space name entirely. Drop it in the comments, because this is exactly the kind of theme where good discussion actually matters. And if you want more videos like this, where we try to find the next important stock before it becomes obvious, subscribe, hit like, and stay close. Because in a market full of crowded trades, sometimes the most valuable story is not the loudest one, it is the one still quietly building its runway.